40 research reports to date about global developments and alternative channels and instruments of finance. These channels and instruments typically emerge from outside the incumbent financial system, and so we're interested in how and why they emerge, and how the developments impact actors in the incumbent system, whether they be FinTech firms or incumbent providers of financial services, businesses, consumers, or regulators. Our center's mission is to create and transfer knowledge addressing emergent gaps to support evidence-based decision-making by market participants, regulators, and related stakeholders. And I think the research we'll be hearing about today exemplifies that mission. It highlights the trends, opportunities, and challenges for lending, equity, and non-investment alternative finance models across more than 180 countries, and is a result of analyzing data collected from more than 1,200 firms. It's the largest data set of its kind, and it provides a global perspective on the development of the alternative finance market. In these uncertain times, this report offers a baseline for market participants to use when they start thinking about what the new normal is going to look like. The new normal I'm referring to, of course, is the environment that all players in the financial system will be operating in as a result of COVID-19. No one can predict exactly what that environment will look like, but some trends likely to shape the new normal are starting to become visible. One COVID impact trend is particularly relevant in the context of this research that we'll hear about today. It's an acceleration in the rate of adoption of digital financial services. The CCF team delivers an online education program called FinTech and Regulatory Innovation for global financial services regulators several times per year. A few weeks ago, I polled the participants in the current cohort, which represent more than 50 countries, and on their views regarding the adoption of digital technology as a result of COVID. More than 96% of them believe adoption will accelerate in their country. The other 4%, of course, said no change. No one thought it was going to decline. So I know that one of our panels today will be exploring this issue in some detail, so I won't preempt that discussion. Before introducing our two presenters, I'd like to thank our financial supporters for this research, Invesco, CME Group Foundation, and the Inter-American Development Bank, without whom this research project would not have been realized. And with that, I'd like to now pass the virtual microphone to Tanya Ziegler of the CCF and Dr. Rotem Schnorr to present the key findings contained in the report.
Thank you so much, Bob. I'm just going to share my screen now for a moment so that you can see the presentation of our slides. Okay, excellent. And I think that you should be able to see them now. First, good morning, good afternoon, and welcome. Thank you very much for joining this session today. The presentation of the key findings is based on this report that took approximately 18 months to complete, and it's my honor and Dr. Rotem Schnorr's honor to be able to talk to you today about some of these key findings. Before we begin, I think it's important to just talk a little bit about the research process. This project has been ongoing for actually 5 years, and the center has produced 15 regionally based alternative finance benchmarking studies. This report is the first time that we have consolidated all of our regional work to produce one global report. In order to do this report, we had to really focus on the capital raising alternative finance taxonomy. Our taxonomy includes about 14 to 15 different models, which we'll be discussing again shortly. The report was truly global and covered 185 different jurisdictions. We received 1,227 unique firm entries that provided 2,322 firm level observations, and that is what the study is based upon. There are 47% of the firms that participated in this study actually operate in more than one country. It was very important to us to have a global study this year, largely because of the vast internationalization that is occurring in this space. So this report allowed us to really look at the nuances and contextualize the different types of activities that are happening across the board. The collection is based on a survey which had 30 questions, 11 of which are required. Every year we ask the same 11 questions, and this is to ensure for time series and longitudinal quantitative data. Our key questions include things like total volume, number of funders and fundraisers, and a series of sort of very quantitative data-driven points that allow us to observe the space and now over the last 5 years. All of the data that is analyzed in this report is presented in aggregate at a country or model level. We never will disclose a unique firm's response. The survey would not have been possible without the assistance of over 50 local research partners. This includes financial technology trade bodies, organizations, and certainly other academic institutions. I'd like to say thank you as well, very specifically to CME Group, Invesco, and the Inter-American Development Bank for supporting this research and making sure that we were able to do this webinar with you today. Now turning to Rosal.
So as you can imagine, such a research project is quite an undertaking, but it's important for us before we present the facts and figures to give you a little overview about the methodological process. So first, when we address issues of data collection, we have quite an extensive list of the actors operating around the world, and we update that periodically. We take around 6 months to gather this data by nagging you repeatedly to answer the survey. Some of you require more nagging, some less, but we are very dedicated and committed to that. Critical platforms are also contacted via alternative channels, and for a few platforms we also do a dedicated web scraping effort, especially because they operate in very many different jurisdictions. But once we have the data collected, we engage in sanitation, where we check the numbers, we explore the outliers or the things that seem to be misreported, and we check that and verify that with the respondents. We also compare data to previous year's results to see any significant changes, and then try to explain these changes and verify them as well. Finally, the analysis itself involves data cats along country, region, and model levels. This is what you see in the report itself as well. We collect insights from industry representatives, and we consult with the various stakeholders to explain some of the trends that we identify. So thank you all for your contribution, and out to the result.
So this report focuses on alternative finance models as they relate to the capital raising space, capital raising activities. Though a somewhat amorphous term, at its core, alternative finance includes activities that have merged outside of the incumbent banking system and traditional capital markets. And in particular, the capital raising alternative finance ecosystem comprises of various lending, equity, and non-investment models. This just shows sort of the key or core models that we see, but our taxonomy actually expands to 15 different model types that relate to the lending, equity, and non-investment space. The key here is that the firms that we are looking at are actively engaging with a number of stakeholders, consumers, SMEs, projects, all of these entities that are trying to raise capital, and their counterparty can be individuals, so retail investors or institutional investors. When we look at the largesse of the space, what we see is that in 2018, $305 billion was funded or raised via online alternative finance platforms. And this funding was delivered to individuals, businesses, or projects. This volume excludes platform fees or additional offline fundraisers. So this is very specifically what was raised and went to fundraisers. Now, what you are obviously going to note here is that from 2017 to 2018, we do see a drop in overall volume. This relates very much to China. China is the significant, the significant global drop stems from the sharp decline in alternative finance activity in China. Now, China does remain the single largest volume contributor, but over time we have seen that the proportion of alternative finance that stems from China has decreased. To give you an idea, in 2017, the volume accounted for 86% of global volumes. This year it shrank to 71, and we are already seeing that the 2019 figures will go down even further. With respect to other leading regions, as I said, this report is a overarching regional analysis where it is very important to have that comparative perspective. And so what we note is that the United States is responsible for 20% of the alternative finance in 2018. The United Kingdom was 3%. And then when we look at the other regions, we see Europe, where we exclude the UK, accounting for 3%. The Asia Pacific, excluding China, is 2%. And Latin America and the Caribbean is just over 1%, with Africa, the Middle East, and Canada all taking sort of around 1% or just under 1% of the volume. Certainly having China involved in the larger conversation makes the overall volumes look like they shrank. But actually, when we exclude this, albeit very substantial outlier, we do note that actually alternative finance between 2017 and 2018 actually did grow substantially by 48%. We do feel, and what we have seen from some of the firms that have started to report their 2019 figures, is that this will continue to grow. As China's market continues to shrink, the rest of the world is certainly taking up the slack. As I said, we collected data from over 185 countries. And so this is just to give you an idea of what this looks like. Obviously, there are certain arenas and regions that are very much volume drivers, whilst others are still quite nascent and emerging. When we look at the top 30 volume driving countries, certainly China is number one with 215 billion in 2018. But then we also see the United States and the United Kingdom. What you will note is that in the United States, with 61 billion in overall volume, this actually represented a 43% increase against the previous year. And in the United Kingdom, we also saw a substantial increase against the previous year of about 30%. Another notable finding this year was that we have a number of unique countries that have surpassed the $1 billion threshold. This includes the Netherlands, Indonesia, Germany, Australia, and Japan. Now, Australia and Japan in 2017 had just reached the 1 billion as well. So we've now added 3 additional countries that are punching very heavily. Another thing to note about the top 30 ranking countries is that just about half of these countries are based in Europe. So 15 of these countries are European, although we do definitely have very heavy hitting countries that are representative of the entire ecosystem.
Okay, when we adjust this to market size, and that is very important, we see very important differences as well about which countries take the leading stand. China, of course, disappears here because of the size of the population, but the United States and the United Kingdom remain leaders. But even more interestingly, we can identify the Baltic countries as some of the biggest and strongest engines today of digital finance. And while they operate very impressively domestically, they're also responsible for quite substantial international activities and the emergence of other countries in which they operate. Particularly countries like Armenia, Georgia are dominated by platforms that are based in the Baltic countries. Netherlands have added to this top list, and but if we want to highlight some unique aspects, so for example, Israel and Finland, compared to other countries, are dominated by equity, at least to a larger extent than other countries. And small countries such as Monaco and Cyprus, of course, get an advantage when you correct for market size. Otherwise, it's mostly European countries that dominate this list as well, with the additions from the Asia Pacific countries like Singapore, New Zealand, and Australia. When we correlate the GDP per capita as an indication of economic capability together with alternative finance volumes per capita, we see a very clear and significant association where the richer the country is, the greater the alternative finance volumes in that country. If we divide this into 3 subgroups that we can identify, then at the top right part of the graph, these are really the top performance on a global basis that come from developed open economies, most of them small economies, but not only, particularly if you look into large countries such as the US. But to the side of it, we see actual countries that seem to benefit the most from alternative finance. And these including these emerging countries such as Armenia and Georgia, Moldova. In Asia, you have Mongolia, and even some Pacific islands like Samoa and Tonga, that the alternative finance there punches well beyond the relative weight. We can also highlight very good performance from 2 African countries, Botswana and Zambia. And when we look into the Latin America countries, then we have Chile, Colombia, Paraguay, and even Nicaragua that seems to be performing above the trend line. The third group includes a very diverse group of countries that underperform. And here we can include some countries where non-alternative finance dominates the markets, such as Iceland, Malta, Puerto Rico, and similar countries. We also have a lot of Arab-rich countries on that end, and this we can explain by many things, maybe a lack of demand in such rich environments, or some religious constraints on the practice of lending, and so on. Next. When we divide the global volumes by models, then we see the absolute dominance of lending. When we look into lending models alone, they take up to 89% of total global volumes. Some of these, despite them being so large, they also exhibit very strong growth rates. Peer-to-peer consumer lending grew 88% compared to previous year, and peer-to-peer business lending grew 44% compared to previous year. On the balance sheet side of things, we see strong growth in the business lending, 84% growth versus 2017, and an amazingly strong growth on the property lending, although albeit from a much smaller rate of above 800% growth. Debuting or fast growing in importance is debt-based securities, growing very fast. And when we look into the non-investment models, we can say that they continue a healthy growth, 15% in reward and 29% in donation, but from a much smaller volumes. So absolutely a dominance of lending in both absolute terms and growth. When we exclude these big heavyweights for each region, China and Asia, UK and Europe, and the US from Americas, we see the composition of the different models and their dominance. All in all, yes, lending dominates across regions. But there's still much greater diversity in Europe, where we see both equity and real estate together mentioned in the top 6 models, something that doesn't exist in other regions, and taking up to 14% of the total volumes in the region, as well as reward crowdfunding with 5%. That's the only region where we see that. In the other region, basically the various models of lending dominate, with the exception of real estate in Asia and donation in Latin America, but still there is a difference. Asia Pacific is mostly driven by consumer lending, while Latin America is mostly driven by business. And that's an important distinction there.
So when we look at some of the key trends that we identified that are key trends across the globe, one of the first is the focus on SME finance. This falls in line very well with a lot of SME access to finance mandates that a number of policymakers and regulators have in their jurisdictions. What you will note is that the overall volume, including China, was just over 80 billion, and this actually accounted for 66% of the observations from our panel. There were 1,531 unique entries that specifically relate to SME finance activity. When we exclude the Chinese activity, what we do note is that business-focused finance actually increased by 47% against the previous year. You will also note that debt-based volumes are the lion's share of business activity, with 91% of volumes deriving from those debt firms. Now, certainly the most logical conclusion is that this is focused heavily on peer-to-peer marketplace business lending, invoice trading, but we also did note a number of peer-to-peer consumer lending platforms that actually are catering to small and micro SMEs, where a personal loan is being utilized for the funding of a business. One of the significant regions that really has a very strong emphasis on SME finance is that of Latin America and the Caribbean, with 60% of the entire region's volume going to SME borrowers, SME fundraisers. With respect to the mix of models, whilst debt-based volumes predominantly coming from those marketplace lending platforms is quite significant, we also saw that 8% of the volume came from the equity-based crowdfunding arena. This is up against the previous year, showing that that actually equity-based models, and in particular equity-based crowdfunding, is growing. And finally, although the non-investment based models take up a small sort of slice of the overall volume pie, it is worth noting that actually there are a significant number of fundraisers, SME fundraisers, that are utilizing this space. And actually, in terms of just number of fundraisers, there are more fundraisers using the non-investment models than that of equity. So what we are seeing is that whilst alternative finance perhaps was previously viewed as, as a last resort option for SME finance, it is increasingly becoming a port of first call for businesses. Another key trend that we're noting is that of an increase of institutional investors making use of alternative finance to support their own or their clients' investment strategies. When we consider alternative finance volumes that are coming from these institutional investors, and these institutional investors tend to be banks, trusts, or brokerage firms, we found that 63% of our observable panel were actually reporting significant volumes deriving from institutional investors, to the tune of 162 billion of alternative finance volume. This is just over 50% of the entire global volume. This is quite important to note because there is a regulatory emphasis on understanding how retail investors interact with this space. So it is quite important to note that actually a very considerable amount of the investment is coming from institutional investors. What you do note is that there are some regions that have much more institutionalization than others. Certainly the most significant is that of the United States, with 88% of the volumes deriving from institutional investors, followed by Canada at 54%. And then what you see is Canada, Europe, the UK, Asia Pacific, the Middle East. It's kind of more, sorry, not Middle East, Latin America and the Caribbean are more closely at that sort of 50-50 range. The notable exception being Africa and the Middle East, where it is very heavily dominated by retail investors. When turning specifically to the models, there are some models that lend themselves to more institutional activity than others. As you can see, the clear examples are that of balance sheet consumer lending, peer-to-peer stroke marketplace consumer lending, but then you also have certain models that lend themselves very heavily to the non-institutional investment side, to the retail investors, and that is, you know, the non-investment models such as reward and donation, but also you see equity crowdfunding, which is vastly dominated by retail investors, and debt-based securities as well at 69%. Sorry, it's not doing it. 1 second. The next trend is that around regulation, and this looks at the extent of how firms are regulated. A platform's opinion on regulation is definitely going to be shaped by the relationship that they have with the regulator in their jurisdiction. So one of the things that we wanted to do is really consider the legal basis in which these firms are operated, so that we can understand sort of what type of FinTech regulation exists and what the impact of bespoke FinTech regulation is specifically to the capital raising arena. What we do note is that there is significant divergence regarding the authorization status across the industry. This data is based on just under 90% of the reporting panel. And what you will note is that by and large, these firms are authorized or having some sort of a legal basis within the jurisdiction that they operate. So for example, you have full authorization of their firm, but also interim permissions or a relationship with another licensed institution. So the majority of the platforms do have that sort of a relationship, either directly or tangentially with a regulator in their jurisdiction. That being said, there are significant examples of not having authorization at all. And you see this in some of the debt models, specifically in Canada, for example, some of the non-investment models across the board. And so this just gives you sort of an idea of what the legal status of these different model types look like across the different regions.
Okay, seems we're already surpassing time, so I will wait for instructions to stop. But until I hear that, I'll just continue. In these graphs, we basically correlated the perceived adequacy of existing regulations in the countries as perceived by the platforms. So this is not an objective evaluation of existing regulation, together with the extent of alternative finance volumes per capita. What we see is a clear positive relationship here, that the more adequate the regulation is perceived to be, the greater the volumes. And this is a very important direction of causality, because regulation enables the alternative finance market to flourish. What we do see in the next slide is that when we isolate this only to investment type model platforms, we see a weaker relationship there. And as you can see, the countries are much more spread out throughout the map. And this basically means that what is considered to be adequate regulation is very different in different environments. And therefore, there's not such a strong relationship when we put that together, specifically in investment, because regulation is even more important in investment than in non-investment type of models. This links nicely to the next theme of internationalization, because if we want to enable platforms to operate across nationally and cross-border, regulation harmonization becomes critical. What we see in this graph is basically the difference between domestically based and international or foreign-based platforms that operate in the same market. The number of these platforms in both situations correlate with the volumes in the market. But we do see two different groups here. One, we have extreme cases, mostly in large countries such as the US, the UK, and so on, where it is mostly driven by domestic-based platforms. But in absolutely the majority of other countries, we see that foreign-based platforms are responsible for a substantial share of volumes being created.
Rotem, in the interest of time, because I know we're running out of time, I'm going to just skip over this trend and just very briefly touch on financial inclusion, and then we'll wrap up. So financial inclusion has been, the hypothesis has been that alternative finance can deliver solutions to financial inclusion, but this is not something that's been readily tested, and so it's an area that we're trying to do more research on. One of the things that we've noted is around the relationship of female funders and female fundraisers vis-a-vis their participation in alternative finance models. As you will see, there are certain models that lend themselves to higher proportion of female activity than others. Certainly, the ecosystem is still dominated by male funders and male fundraisers, but when you compare this to traditional avenues, certainly alternative finance is delivering to the female to female entrepreneurs, to female borrowers, and certainly to female investors as well. And then with respect to the banking status by region, we did want to analyze and understand, what proportion of fundraisers were unbanked, underbanked, and banked. Now, the vast majority, especially in places like Europe and the United States and the United Kingdom, are catering to banked individuals or banked SMEs. But you do see high proportions of underbanked individuals also utilizing the space. And then we have examples in Africa, the Asia Pacific, and Latin America and the Caribbean, where actually unbanked individuals are also able to utilize alternative finance to capture credit where they were not able to previously. Looking forward, we are going to be continuing our longitudinal data, and so this Global Alternative Finance Survey will be relaunched again in the coming weeks to capture the 2019 data. Certainly, it is very important for us to continue monitoring this industry that is dynamically growing throughout time, identifying those challenges and market trends across the ecosystem at a global level, but then certainly looking at the regional and country level context as well. Throughout the report, you will note that we, in addition to talking about sort of overarching global trends, we have a chapter for each jurisdiction and then key countries. Now, given the current environment, we would be remiss not to talk about the COVID-19 impact. And for that reason, we will be integrating a COVID-19 rapid assessment into our global alternative finance benchmarking activity. This activity is actually going to be a co-piloted program with the World Bank that we'll be launching alongside the Global Alternative Finance Survey. And this survey and research module will capture industry level responses from 10 different FinTech verticals. With respect to the sort of key areas that we feel we really want to understand more, and where we're seeing trends is certainly, collaboration with traditional finance, where traditional institutions are collaborating either through ownership or strategic partnerships. Certainly understanding financial accessibility, and this really relates to that financial inclusion point. Looking at the technological upgrades and really the R&D activities that firms are taking to really hone in their digital capacities. And finally, proliferation and consolidation of the market. As the market is maturing, we would like to see, how this arena continues to develop. And with that, thank you very much for your attention. We are going to, it is my pleasure now to introduce the first panel. The first panel is going to be led by Diego Herrera. Diego, if you are able to turn on your screen, and I invite the panelists from panel 1 to also turn on their screens now. Brilliant. And I will hide myself now.
Can you listen to me now?
Yes, we can hear you.
Okay, perfect. Thank you very much. First of all, I have to say that I'm contributing to this panel in my personal capacity. The views expressed are my own only and do not necessarily represent the views of the Inter-American Development Bank, IDB, group or its employees. Secondly, okay, so kudos and thank you, Bob, Brian, Tanya, and all the CCAF team. Our 5 years partnership is very, very fruitful. I think that it was brilliant to compile the global ecosystem for alternative finance and crowdfunding into one unique document. The idea for this first panel is to deliver the point of view of a financial supervisor represented by Laura Clavijo. She's the Director of Innovation at the Financial Superintendents of Colombia. Also a member from the industry, specifically a FinTech association, Angel, who is the Executive Director of FinTech Chile, and an investor. I don't know if call him William or Guillermo. I think that William, because we are speaking in English. Guillermo or William is the TMT head at IDB Invest, our private branch, the private branch of IDB Group. All of them are going to talk about FinTech and SME. All of them are also my friends for many years in the ecosystem and also belong to FinTech LAC, IDB's network to foster the FinTech ecosystem in Latin America and the Caribbean. Please find us in LinkedIn. And we will also touch base briefly on the COVID crisis. To that purpose, we will focus on Latin America and the Caribbean, given that the Global Alternative Finance Benchmark Report shows how 60% of the 1.8 billion originated in Latin America were dedicated to MSMEs. That makes this region unique against others around the world, just as Tanya showed some minutes before. I'm going to give some quick data to give context, which we will include in our recommendations discussion paper from IDB to be published early in May. So across developing countries around the world, the MSME finance demands gap, the difference between supply and demand, reaches more than $5 trillion, almost 20% of their GDP. In Latin America and the Caribbean, we speak of a demand of around $1.3 trillion and a gap of 1 trillion, equivalent to 20% of the regional GDP. The challenge for MSME credit was massive before the pandemic. To that extent, literature shows how in times of economic and financial crisis, lenders elevate their standards and improve their financial ratios in a rather procyclical fashion. In fact, lenders might be reluctant to offer credit, request for higher collaterals, among other reactions to the, let's say, increase in credit risk, creating a vicious circle between the financial system and the real sector that deepens recessions. Bernanke, former chief of the Fed, and others show how this happens through a financial accelerator, that's how they call it, that ends up worsening and deepening crisis. Fintechs and fintech platforms, specifically those devoted to credit, cannot escape this cycle, but at the time can be the part of the solution in a very delicate balance that policymakers are watching very, very closely. So how can fintech be part of the solution, and how can adequate regulations and policies enable technologies and fintech platforms to solve some of the issues and to collaborate in this context? This is what we're going to talk about. So to all my panelists, as we rehearsed, very briefly, I'm going to start with the first question. So SME-focused finance is a hallmark of the alternative finance landscape in LAC. Can you provide some context as to why there is such a substantial emphasis in SME activity? How does this relate to the regulatory policy priorities across the region? What does this mean when considering the future of the region in the light of COVID-19? I would start with Laura, and then I would move to Angel. I'll mute myself.
Thank you, Diego, and thank you all for the opportunity of speaking on this very interesting launch of the report. The report brings, in fact, many of the conclusions that it draws from the data, a very ample base of the surveys, well, really hits home when we talk about Latin America and how FinTech and alternative finance, despite they promise the democratization of financing, truth be told, we're still far from getting there. So just some information on how we already had a problem in terms of SME financing in the Latin American region. And also to note that many of these very MSMEs, micro and entrepreneurs, are really also the base of employment for our region, a problem that, of course, in light of the pandemic, will only get worse. So as Diego was mentioning, the procyclicality of credit will not be something exogenous to what the pandemic is showing. Perhaps just to give a sense of what the problem we were seeing before the pandemic and trying to give some light on how to move forward. Truth be told, in Latin America, the real problem of informality, which leads to lack of productivity in terms of these these SMEs and these firms, well, really is really a problem in terms of how we move forward in terms of getting financing to these companies. The lack of good information in terms of credit history, financial statements for many of these firms is a problem that we've been facing for a very long time, and not a problem that you just sort of subside overnight. Even though the pandemic might bring an opportunity in terms of having better digital information and putting forward the need for better information. So informality, lack of information will result also in a deeper risk perception of these companies. And that's also something that we see today, and we're definitely seeing for these micro firms in the current juncture. Many of these are going to be suffering in a very important manner, especially in some industries and some sectors. And really just the lack of credit worthiness for many of these firms in line with the lack of information, perhaps is driving the fact that alternative finance, even though it has the big opportunity and as the report shows, has been growing in Latin America in a very important manner, we're still from reaching its true potential. So these are some of the things that we as policymakers should be thinking about. How do we get to better information so alternative finance and FinTech lending firms can really do what we hope they can do in terms of financial inclusion, is getting to the underserved segments of the population.
Thank you very much, Lara. That was very interesting. Angel, how about the perspective from the FinTechs?
Great, thank you, Diego, and everybody. Congrats again for this amazing study. I think it's really necessary for all the world to measure how everybody's performing when we talk about lending, alternative lending, financing. And well, regarding Chile, some important facts to mention. Well, here in Chile, with a population of 70 million people, we have 1 million SMEs and 1 million SMEs, and they represent 98% of all the companies in the country. They gather something like 70% of the jobs of Chile. So SMEs are really, really important for Chile. So when we talk about how fintechs can contribute with these companies, with these SMEs. In Chile, we have a particular situation with the invoice trading, or the electronic invoice. Before we talk about that, maybe about a fintech law or fintech regulation, in Chile, we have a particular situation is that we don't have yet a fintech law, let's say, but Chile, from 5 or maybe 7 years ago, has been working to digitalize the economy. So we are not talking just about fintech, but about digitalization of the invoices of the government and so on. So today, fintechs are taking advantage of that because indeed, in our case, that now Chile is the second alternative finance generator, just after Brazil, but above Mexico and Colombia. The invoices is the key because we have a really deep electronic invoice market. And this is the way how fintechs are contributing with SMEs. In addition, our government, the regulator, is working on several measures to boost all this finance through fintechs. But the key point is the digitalization of the economy. If a government not only have the focus on measures to regulate fintechs, but to digitalize its economy, fintechs will find a business and a way to help, to contribute. So that's the point of view in Chile.
Thank you very much, Angel. I would like to ask Guillermo in the same fashion, but I would like to ask him two questions. Guillermo, can you provide some context as to why MSMEs are important from the perspective of IDB Invest, and what are you doing in the MSME fintech space to the date?
So thanks a lot, Diego, and congratulations on the report. Let me start with some background. SMEs are clearly the backbone of most economies in Latin America. Angel just mentioned the numbers for Chile. If we look at the region, the numbers are similar. Over 99% of firms in this region are SMEs, and they represent 1/3 of GDP and probably around 2/3 of employment. And in some countries like Colombia and Peru, the numbers are even bigger than that. The problems faced by SMEs are well understood, and there are many. The obvious one is poor access to credit. Diego, you mentioned the financing gap of 1.3 trillion in Latin America. That's huge. You didn't mention the gap among women-led SMEs, which is also huge. And particularly, there's an asymmetry of information. What we find is that traditional lenders really know very little about the real credit risk of many of these companies. So in our view, fintechs can definitely help leapfrog these challenges. How? Through digital and cloud solutions, through data, and here I mean real-time transactional data, and also through the statistical value of non-traditional data. For example, loan requests that come in through Google searches saying I need a loan fast clearly will have a lower score than one saying I need a loan to grow. So that's just one example. Why are SMEs important to IDB Invest? At the end of the day, we are DFI, a development finance institution. Our mission is to reduce poverty and have an impact. And by supporting SMEs, we're helping increase financial inclusion. And this allows us to achieve the SDGs, which are the Sustainable Development Goals, which of course are our mandate. And needless to say, with COVID, the relevance of supporting SMEs has clearly increased. What have we done at IDB? IDB has 3 separate organizations. You're part of the bank, Diego, the public side. Clearly a lot of activities in terms of guiding policy and framing the agenda with governments and regulators. We have the IDB Lab, which is our innovation arm. IDB Lab does many seed investments on rounds A and indirectly invest through a very broad portfolio of, at this stage, probably over 50 venture capital funds, which include over 600 startups, of which many, and I'm just guessing, probably more than half, our fintechs. And finally, through my part of the bank, we decided to be Invest. We started investing in fintechs 3 years ago. Initially, we started with equity investments, and we quickly pivoted to SME lending because we saw that equity capital in the region was largely available. Just to give you an example, last year in Latin America alone, $2.5 billion were invested in equity in fintechs. This year, it's probably going to be lower because of obvious reasons. But there was limited debt options for fintechs, and that's the gap that we're trying to fill. We also found that through structured debt solutions, we could lend to some of these fintech portfolios with a better structure and better credit worthiness than if we were lending to fintechs directly. So quickly, some examples of what we've done. We recently invested $50 million in Victory Park Capital, which is a dedicated fund doing debt for fintechs in the region. We lent $70 million to a ride-hailing company, which was rolling out payments and lending for its drivers. We fully subscribed a bond for Mercado Pago in Brazil for $50 million, with proceeds being used to support their power sellers under the platform. This is the largest e-commerce platform in the region. And more importantly than that, with COVID, I mean, our business really has, the opportunities have accelerated. Of course, we're being cautious, but we have something very big going on in Brazil with the largest digital bank in the region. We're also closing a warehousing line with the largest online SME lender in Mexico. And finally, this is very interesting for fintechs, we're closing a venture debt fund, which is a great product for these type of companies.
Okay, thank you very much for your answers. We had a script before, but now I'm going to merge some of the questions so we can move faster given the time restrictions. So I would like to ask, what is the role of regulation vis-a-vis the fintech ecosystem? How a regulator enables innovation against considerations such as consumer protection, risk mitigation, and so forth? And to that extent, how public policy can merge with regulation and help out the fintech ecosystem, the fostering of the fintech ecosystem. I would say, Laura, you start, then Angel, and then Guillermo.
Thank you, Diego.
Please be fast because we have a very stringent time restriction. Thank you.
Sure. Just one point that when we look at regulation, especially in Latin America, I think we've moved forward in terms of embracing and taking into account the importance of fostering innovation in our financial sector. But sometimes it's really about striking the right balance between regulation and not hindering some of these innovation and very innovative business models. So even though I think we're moving forward in terms of regulation and embracing fintech for what it comes, we still sometimes fall short in terms of having an open mindset to innovation. Maybe because we feel we're just jumping into an abyss with some of these technologies or some of these innovative models. And of course, we want to protect consumers and we want to promote financial inclusion. So it's really about striking that right balance. How can we go about that? Sometimes it's not about just having regulatory reform in place. I think innovative facilitators of innovation can be a really good tool. For example, what are innovation hubs, regulatory sandbox. In the case of Colombia, we moved forward in this sense, and we've also made regulatory amendments to promote some of these business models and give safeguards to the community. But definitely having a mindset open to experimentation will give regulators and policymakers in a more agile and transparent way insights in terms of where regulatory reform should be moving.
Angel, what's your perspective on that take?
Well, in our case, as I mentioned, in Chile, we don't have a fintech law. We have general indication from the government about how to perform with the rules we already have. So definitely, it will be helpful to have a regulation, but as I mentioned before, if a government have a digitalization strategy on the economy, on the government itself, this is going to be perfect for fintechs. For instance, in Chile, we are not in deep with regulation, let's say, because it will come in some months. In this precise moment, we are on business. How with the tools we have, how to perform better and grow the most we can. For instance, in this precise situation with the pandemic, I mentioned that in Chile, 50% of companies don't have a bank account, and most of the incentives or support that the government will give to those SMEs will go down through banks. So fintechs and other non-banking institutions, let's say, will be a really important tool for the government to bring all these funds to these SMEs. So the important thing today is to work hard with the tools we have, and regulation will be great in the future, but today we have important things with the electronic invoice. We need really fast a GDPR law, a cybersecurity law, and with that, I think we will continue growing our financial help to companies.
Thank you, Angel. I think that leads me to the next question. Angel mentioned the COVID-19 pandemic. I think that it is out of the question that fintech platforms have a role in this current context. From your points of view, and this time I will start with Guillermo, then move to Laura, and end up with Angel. How do you think that fintech platforms might bring solutions to delivering financial services to people in this current context? Currently, from IDB, we're trying to deploy resources to vulnerable populations in terms of payment and subsidies, also credit to MSMEs all across the region to cope with this current crisis. And it's been very hard to deploy these resources to the last mile. How do you think that fintechs might help in this context? Guillermo.
Yeah, thanks, Diego. Further to fintechs and platforms, I think what's pretty obvious is that the digital transformation of banking will accelerate. This crisis is like a wake-up call for most traditional banks, and clearly an opportunity for fintechs. I think we'll be seeing more momentum towards things like more efficient customer acquisition, for example, or more efficient or effective underwriting models, more flexible digital onboarding, digital signatures. I think we'll also see an acceleration of open banking discussions. So far, there are only 2 countries advanced in that. We'll be seeing a little bit more of that, I think. And most importantly, I think there's a deep realization that fintechs can provide the railings or the core infrastructure to quickly deploy cash during the emergency period of COVID and in the recovery phases. Just look at what's going on in the US with the PPP program of 600 billion. That's relying partly on fintechs. The government of Colombia has also enacted a program, and for the first time, it's shortlisting some fintechs in order to deploy those funds with the Colombian government guarantee. And in short, our role at IDB Invest will be to continue to support SME online lenders. However, I do have some concerns. This is probably the first time that fintech lenders are experiencing a down cycle, and it's a huge one. My question is, will the underwriting model stand up? I'm betting that in many cases, NPLs may go through the roof. And let's face it, algorithms are not really set up to deal with this type of black swan events. Another big concern is funding. Fintechs are usually startups. So the questions I would have is, does a fintech have the cash to survive in the next 12 to 18 months? Can they scale down or up depending on their business? Can the infrastructure support the additional volumes? Look at what happened with Robinhood's outages in the US. What are going to be the debt funding options going forward? And finally, another concern is how quickly will many of these fintechs form partnerships? That's going to be critical, I think.
Thank you very much. I think you highlight a very relevant point, the last one. And I would like to move to Laura.
Yes. In fact, we have seen, as you mentioned, in Colombia, the support of government interaction with fintechs, seeing that they are perhaps in some cases more capable of reaching that last mile to some of the population. Nevertheless, this pandemic, of course, puts very forefront the lack of accessibility and digital transformation in rural areas, the young and unemployed, women population. So even though we do feel that this pandemic will, of course, not only accelerate the technology which is being implemented, but also the infrastructure for digital transformation. And we're already seeing it in terms of the amount of transactions that are being done on digital platforms instead of going to branches just because of the lockdown. But we definitely feel that financial inclusion, I mean, we've been trying to push for financial inclusion for the past few decades. And this really sort of goes from a push to a shove in terms of financial inclusion. And we're hoping that this shove will definitely put forth the importance and opportunity of going digital and moving forward. And definitely fintechs have an important place for this ecosystem. We definitely also feel that this will definitely set apart those fintechs that really have some scalable and very relevant solutions and have some funding already in place from the more startups that are still sort of reinventing and trying to adapt to this. So fintechs that will prove resilient are already being backed by customer demand and government support. And so I think that space will be thriving. But on the other hand, I mean, financial inclusion in terms of how the credit risk profile of some of these SMEs, that will not be, that will only look worse, at least in the short term.
Thank you very much, Laura. That was very clear. Angel, could you move, please, really fast with the answer? And then I have a couple of questions. One is for Laura and another one for the rest of the team.
Thanks, Diego. Well, yes, fintechs will play a really important role in these pandemics and in the future, because governments will finally realize the capacity of digital to go to the last mile and reach all those banks and all those SMEs and people that are unable to receive the financial service. So fintechs will play a key role. And in addition, not only fintechs, but fintech associations will have a really important role to coordinate that dialogues, because it's important to highlight that, of course, governments are really focusing on other measures like health and so on. But a fintech association can play a really important role to connect banks, to connect fintechs, to connect all the players that contribute with the digitalization of the money, of finance. So fintechs will be a key player from now on until in the future with alternative finance for SMEs and people.
Okay, thank you very much. So Laura, there is a direct question for you here from the audience. The question is, in Latin America, which is the approach of the regulator and the supervisor in order to promote alternative finance, particularly crowdfunding?
Well, in Latin America, and I think the report really gives good insights and data on crowdfunding and alternative finance in general for the Latin American region. So I think it's really a really good report to start from. Across the board in Latin America, and as Diego mentioned, we're part of the FinTech LAC, which is this community of regulators and supervisors in the Latin American region trying to promote innovation, financial services. I think all the different countries, even though we come from different places and have different regulatory schemes or regular approach, different government initiatives. I think we're all online in terms of moving forward and fostering innovation. That said, that doesn't mean that everyone has the same proactive approach. I can only speak about Colombia, and we've really moved forward in the past 2 years from our innovation initiative from the supervisor. And this juncture really puts forth the importance of moving with digital transformation and reaching sort of those underserved segments in terms of infrastructure, connectivity, financial education. So our standpoint is really about promoting innovation, and we really feel that this juncture only is putting this to test. In terms of Latin America, we also feel that that's also the case. In Colombia, crowdfunding has been approved, and the report draws from that. In Colombia specifically, we still have some other type of regulatory restrictions in terms of sort of P2P lending. So we still have a way to work around regulatory barriers. But having a regulator and a supervisor that is in front of the line of having the discussions with the FinTech associations, the technology companies, at least we feel it's a good place to have those conversations, even though we might not, because of risk perception or just regulatory difficulties, not move forward in that direction. Having the conversation, I think, is really a really good starting point, and definitely Latin America is online with this.
All right, thank you very much, Laura, and thank you for mentioning FinTech LAC. The final question, each of you will have 30 seconds. I know it's very challenging, so get your minds ready, and Guillermo will be the first in answering this question. The question deals with informality, how to deal with informality all across Latin America, given that MSMEs are highly informal. The person says that in Mexico, more than 50% of the MSMEs are informal, and that taxation plays a very important role for the adoption of let's say, for getting to financial services. So, Guillermo, how we can deal with the issue of informality? 30 seconds.
Yeah, no, informality is huge in Latin America, and I think fintechs to a large extent help in dealing with this informality. Many people who borrow online from a fintech for the first time start generating a credit history that can then be taken to more traditional institutions.
Laura.
In line with what Guillermo was mentioning, definitely I go back to the information, and perhaps open banking initiatives, as was mentioned before, will also make more transparent, more accessible, and real-time information for those that we still feel are invisible. Even in a pandemic such as this, there's a lot of information out there that companies or fintechs are just not able to really capitalize on.
And Angel.
Well, Diego, this is great to listen to this question, because right now in FinTech Chile, we are working in the digitalization of money, not only alternative finance, but digitalization of money. And when you digitalize the money, a government will be able to know where the money is and where it moves to, So when do you digitalize the money, you can understand what's the performance of a SME, being this, even if it has a bank or not. And with this measure, I think the government can create political measures to help the SMEs and people underserved.
Okay, I would like to thank all of our panelists today. I think that we covered pretty much what people wanted to hear. There are some more questions from the audience, but I will ask them privately to all of you. And I think that from the side of IDB, we do think that FinTech is part of the solution. And only one thing I would like to mention is that digital onboarding is the key part of the question here. and we should work towards that with policymakers all across the region. And that's all I have to say. Thank you very much, everyone. And thank you, Sika, for giving us this opportunity.
Thank you so much, Diego, and thank you so much, panelists and team. We really appreciate your insights. We're now going to be transitioning to the second panel, and the second panel is on the future of FinTech, in response to the COVID-19 crisis. While we're getting those panelists ready, you will see a poll appear on your screen. If you could please respond to this poll. This poll is to just give a little bit of context around the impact of the COVID-19. The question is, how do you think the rate of adoption of digital delivery of financial services in your country will change due to COVID-19? And we're going to leave that poll up. And I'm now going to introduce Dave Dowsett of Invesco. Dave is the moderator and lead of this panel. Dave, whenever you're ready, and please, panelists that are on Dave's panel, please go ahead and unmute yourself and put yourself on video, please.
Thank you, Tanya. I take it you can hear me okay?
Yes, you're coming in loud and clear.
Thank you. Thanks everyone for joining today and for taking the time to participate with us virtually from around the world. We're really happy to have opportunities like this that keep us connected and informed, really despite the current circumstances. During today's panel, we'll be asking the panelists about the future of FinTech in response to COVID-19. But before we get started, I'd like to just briefly introduce myself and take a few minutes to have the panelists introduce themselves as well. My name is Dave Dowsett. I'm based in Atlanta, Georgia. I'm the Global Head of Emerging Technology, AI, Tech Strategy, which aligns very heavily to FinTech and intentional innovation for Invesco globally. Part of this role includes really creating and maintaining relationships with the academic, entrepreneurship, and FinTech communities around the world to understand how Invesco can strengthen our capabilities through our partnerships, and how we can make advancements in technology as well. This is why we're happy to sponsor these events and the creation of these reports, like the Global Alternative Finance Benchmarking Report. So today's topic is particularly close to me because of Invesco's experience in having to respond to the challenging needs of employees and clients due to the pandemic. So we're very fortunate to have a great global panel today, and I'm going to turn it over to them to let them introduce themselves, and then post that I'm going to start posing some questions out to the panel. So maybe, Ines, could we start with you, maybe to give an introduction on yourself, and maybe each of you can also just mention where you're located around the world.
Sure. Well, first of all, hello, everyone. I'm Ines Lazdowska. I'm General Counsel of Mintos. Mintos is a marketplace for loans. It's one of the players of the alternative finance world that we just heard about being researched thoroughly within the scope of the research of the center. And thank you very much for the wonderful report. It's an interesting read. I'm based in Riga, in Latvia, in Baltics. We are headquartered here. However, we have part of the team located around other offices. I have myself banking background as well as now also alternative finance world background. And these discussions today are particularly interesting to me personally, given my professional experience as well as from Mintos' perspective, now seeing the impact of COVID-19 and the current events on both markets, on the regulated ones and unregulated. So thank you very much for inviting me to this panel, and I look forward to the further discussion.
Thank you. Ronald, maybe perhaps you can go next.
Thank you, Dave, and thanks for this for the invitation here. So my name is Ronald Klevelaan. I'm the director of the European Center for Alternative Finance. I'm based in the Netherlands. I saw in the presentation that we are currently on the 4th place of the list, so not bad for a small country like the Netherlands. The European Center for Alternative Finance is a research center, academic research center. We work together with researchers from all over Europe, bring together research centers, individual researchers. So therefore we work closely together with the Cambridge Research Center, Acta University with Rotem, but also the other research centers in Europe to identify the development, the growth and the trends on alternative finance on an academic level. We bring them together every year in Utrecht to share their insights and to share the latest trends. And we run also several large European projects. So we work together closely with the European Commission to find out what the Capital Market Union, for example, how that should be adjusted and how to make sure that alternative finance will get a really prominent place in the finance industry, especially SME finance industry.
That's great, thank you. Peter?
Yeah, thanks, Dave. Peter Renton. I am the chairman and co-founder of Lended FinTech and also the founder of Lend Academy. Lended FinTech is a global conference series. We have conferences dedicated to FinTech. We have conferences. We're in the USA, in the UK, and in Latin America. We've also have previously had conferences in China. Also, I produce a weekly podcast, and we write about the industry a lot. I'm based in Denver, Colorado, in the US. We have our head office is in New York, and we also have a small office in London.
Great, thank you. And last but not least, Anil.
Hi everyone, my name is Anil Stocker. I'm co-founder CEO of a company called Market Finance. We are an online SME credit platform that's been around since 2012 when we started. It was we're one of the first generation of online lenders based here in London. We've done nearly 3 billion through our platform to small businesses here in the UK, primarily through an invoice finance product and also a business loans product that we have now launched. And we have been in touch with the Institute in Cambridge from the beginning and sharing data and trying to build awareness for the industry. So it's great to be here on the panel today.
Thank you. So thanks everyone for those great introductions. As you can see, everyone, we've got a really diverse, well-rounded panel. So we're going to dig into some questions now. And as we all know and have experienced, the COVID-19 pandemic has forced firms to think about how they operate and run their day-to-day business. And we are seeing new opportunities arise for some and new challenges arise for the others. I appreciate it's a similar question that the previous panel asked, but I wanted to ask it as well to get the view from this global panel. And so really what I'd like to do is throw it out there and say, so what have you all experienced or noticed, if anything, in terms of pivots in products or service offerings, target client groups, or even pricing models due to the pandemic? And I'd like to start by just throwing that out to all and just seeing who would like to start first on that.
I could go first. I guess when the COVID pandemic hit, there was a bunch of work we had to do straight away around risk and pricing. So we had to look at our customer base, we had to look at the sectors they were in, we had to look at the supply chains that they were in, and we had to reprice risk because we have investors, private investors, be that banks, asset managers, family offices who are putting money onto the platform. So we did reprice on average. We kind of moved from around 6%, 5-6% net yields to up to around 8-9% net yields. We also did kind of deep dives in the sectors to figure out which sectors were most at risk from COVID and which sectors were actually benefiting from COVID. So, for example, supermarkets, healthcare, pharma, those were seeing big increases in demand. So we quickly kind of we're able to, given our lending products quite short duration, we're able to kind of scale in and out of sectors pretty quickly, which is an advantage for investors on our platform. We also then took a look at the government schemes, government interventions. I think that's happening across many different countries. In the UK, there are programs with government guarantees for small business funding. We're looking to get accredited on that so that we can start to disperse funds with government guarantees. We also looked at the furlough scheme in quite some detail. This is a scheme in the UK where private companies can switch their employees onto a state salary. And often they're having to wait 10-15 days to get those payments through reimbursed. So we were looking to adapt our invoice finance model to that, which was kind of an innovative thing to do to help the SME community. So yeah, a bunch of things. You have to move. We've moved. It's felt like we've done, kind of 6 months worth of work in a couple of weeks. But that's what a pandemic does, I guess. Your delivery.
Yeah, sounds like great work. Congratulations on that. Anyone else have a view on the panel?
Yeah, so I think here in the US, we've had a very challenging time. I think it's impacted financial services dramatically. I would say in the small business sector, like Anil was just saying, the first thing that lenders did was tighten in their credit box. In fact, many lenders in the US have stopped lending completely to small businesses. And those that are still lending, because right now we've got this thing called the Paycheck Protection Program, the PPP. I know you've got C-bills in the UK, but we here it's all small businesses, pretty much all small business lending has stopped, and everyone is just focusing on this PPP program. And they've got, there's been over 1 million loans done. Now there's, in this second round, will probably be over another 1 million loans. So basically all small businesses are really focusing on getting access to that finance now. It hasn't happened. I mean, FinTech is playing a role. It has been a little hamstrung because the government has been very slow to approve. I think similar things are happening in the UK. But so that's on the small business side. Then we got digital banking, and digital banking is booming. There's some of the digital banks here in the US are seeing record inflows of new customers. They're seeing record uptake from their existing customers, just a lot more engagement because people are no longer visiting their bank branch because these stay-at-home orders. So a lot of people who never did digital banking before have started in the last 6 weeks. So that's another big change. And then on the consumer lending front, consumer lenders have not been as badly impacted as the small business lenders, but pretty much all of them have tightened their credit box. There are some, like some of the point of sale lenders are actually increasing their volumes as people are staying at home and buying things like Peloton bikes and office supplies and home supplies, doing that on with point of sale financing.
Interesting. Ines, were you going to say something? I don't know if I saw you.
Yes, I could probably add from investor perspective the things that we at Mintos have been doing ever since I would say mid-March, or maybe even sooner than that, when the financial markets started to feel the effect of the pandemic. One of the things that is maybe making Mintos stand out compared to some other platforms is that we have vast majority of retail investors working with us. And we ourselves do not do the credit scoring. We as Mintos don't issue the loans. We work with lending companies from across various countries, from around 30, and we are kind of the middleman in the between. So one fundamental thing we have been doing ever since mid-March, early March, is basically doing, in addition to what we have done always, and servicing the investment opportunity in loans, we have been also now heavily monitoring the situation in the countries of the loan originators, various changes about regulatory frameworks, the regulations of lockdowns, what are the regulatory frameworks around debt moratoriums, basically monitoring the things that are of high importance to the investors. And not only monitoring that, but also translating it into understandable language for retail investors, which is very important. And the number of publications on our blog post and our website, I think has increased dramatically. And we try to live up to our value of transparency and investing a lot of time into that. And it seems to be paying off. The investors do appreciate the level of information they get access to these days. They are very interested in what's happening to the investments that they own, and they are very interested in seeing how things evolve. And they do appreciate the level of detail that they get access to these days, in addition to us providing the service that they usually would have anyway.
Thank you. I think going to more.
Can I add something, Dave, for a bit more, a bit more wider view? Because I was really interested to see that what Anil already said and Ines. So we see the whole transformation, the digital transformation, is speeding up now, and we see a lot of these fintech companies that are much more easier to quickly adapt their business model, quickly to launch new innovative services. And what we generally see in Europe is that there are two types of activities now. The first one is really focusing on liquidity. So of course, all the governance schemes, but also the fintech platforms focus on how to get the liquidity into, or keep the liquidity into the companies. So a lot of the platforms, even lending and equity platforms, are launching now reward-based crowdfunding campaigns, helping out, selling vouchers, supporting their customers, that they are able to support the companies directly. Of course, the invoice trading companies are doing a great job now. Short-term loans are going to the roof. And with or without the government guarantees. So where possible, indeed, what Anil said, if there are governmental guarantees, they try to use them, or if they can distribute funding from the government, of course, they look into that. But they also launch their own initiatives, and they also try to support their own customers already, or launch new potential solutions that can be used, that are really focused on the short term. A bit longer change that's happening now, and that's something that we've seen now in the last few weeks. Now we see that this crisis has a huge impact also in the future. You have to rethink as a company, how will your future look like? So also, how will your funding structure look like? And what we've seen in Europe is that traditionally already, a lot of the funding, a lot of the companies, and especially the SMEs, are mostly debt-based funded. So they don't have a strong equity element in their funding strategy. And now you see that with all these government activities, a lot of them are focusing on providing more loans. And that this causes these companies to be overly funded by too many loans, too much in debt. And now you see that there's a new wave of companies, new wave of activities trying to focus on how do we get more equity or equity-like funding into these companies. So that's a big change now, that we see a fundamental change in the funding strategies for SMEs in Europe at least. So that's something that's a big trend that we see now, and it'll be interesting to see in the next couple of years, in the next reports of Cambridge, if this also is shown in the statistics, of course.
Fascinating. I think maybe to follow on from that, Ronald, and maybe even Peter, and anyone else if you want to add to it, but from an educational research point of view, how are you seeing fintechs addressing furloughs and kind of the changing labor markets, if at all yet?
So I think that the fintechs are struggling here in the US, and that with in certain sectors. So as I said, that consumer lenders, we had Lending Club announced just last week they're furloughing. They furloughed a third of their workforce. There are others in the small business lending space that are also furloughing. I think, given that in the US doesn't have the same kinds of safety nets as European countries, I think that it's going to be a struggle. I feel like that this temporary moment in time, I think you're going to see a real kind of culling of the herd in fintech, where there's going to be those companies that were strong before the crisis are going to end up being the winners, and those that were struggling before the crisis, they're not going to be able to raise new money. They're not going to be able to really survive. And I think you're going to see a lot of M&A where companies are picked up for very, very little money, and it's going to see the biggest consolidation we've probably ever seen here in the US in fintech.
Yeah, I agree with that. So what we see now also is that a lot of these companies that are indeed trying to survive now, so they were not that good before the crisis and trying to survive now, some of them need indeed help, either through M&As or at least or perhaps to close down on a normal way. And I know that's not a nice thing to say, but we know for sure that a lot of these companies will go bankrupt. So how do we make sure that the impact of the bankruptcy is not too big on the workforce, and how do we make sure that the workforce still got an opportunity to move ahead and to get into new jobs. That will be the big challenge that we will see after the first months of this crisis, because we know for sure a lot of these companies will not survive. And also, that's also the same in the fintech industry.
Thank you. Moving on a bit, really, government responses around the world have been varied as to how different world leaders and governing bodies are addressing economic and really regulatory impacts of COVID-19. What do you think governments should have done or should be doing differently to support fintechs during this pandemic? I mean, maybe I'll start, Ines. In your role as head of legal, is there a particular legal angle to view this topic?
There indeed is. Well, first of all, number of measures, they are regulatory work, first of all. So it is interesting to see what is happening across the globe. Well, we are ourselves based in Baltics in EU. So the developments on EU level is something that, that definitely we can relate to and look into more deeply, I would say, as a company and as a service provider. Well, one thing I did note yesterday is that European Commission announced a number of measures for the banks to be able to facilitate lending to households and to SMEs, to companies. Very interesting package. And I think that even though this particular package is aimed at banking sector, and they definitely do need it, there's no question about it, because the effect of this pandemic and the crisis on the banking sector and their capital adequacy requirements, well, it's very significant. So it was a very much needed package of measures. However, I believe that this is a very good example of what also the alternative market players could see as a package for them, either on likewise EU level or a national level. So alternative market players are more subject to national, local legislation rather than EU-wide frameworks or other regional frameworks or supranational. But this is a very, very good example in my view, at least to seek for ideas how to help. One of the things in that package is around a solution with respect to treatment of expected credit loss. And that is something that, that most likely not only banks can relate to as a current problem, but also the alternative lending market players, namely the lending companies. So I would gladly see how it evolves and whether any of the national regulators, national legislators take on the initiative and see how much they can adopt from that package of measures for non-banks. Well, we heard at the beginning of this discussion today, of this event, what a significant share of the entire finance market is the alternative lending market. And it definitely should not be forgotten as a market player. One of the things that, that it would be interesting if it evolves and again brings a positive addition to the market trend is whether the countries would even more start engaging alternative market players and non-bank lenders in deployment of the funds now being given to the markets. It was already mentioned before during today's discussion that primarily we see that those response funds are being deployed through the bank lenders. But again, given the technology and the tools that the non-bank lenders these days have, and all the technology around it and the possibilities it gives, it would be a waste of a very significant market at this point in time if they would not be engaged and allowed to facilitate lending as well. A very good read recently was on Crowdfund Insider, an interview with Lend Invest, and it was mentioned there as an example what can be seen happening in UK and how slow the UK banks are actually with deploying the funds that are available to them. So there are a number of examples out there. That particular interview is just one illustration. So I think those two aspects to it at this point in time maybe are the key to, first of all, to see how it would be fair to help the alternative market players for them to pull through this crisis and to actually being able to continue to be able to contribute to the market. And then again, how to engage them in the solutions that currently need to be sought, and to help them to make the partnerships that they actually very much need in this time.
Yeah, I would just add to that is that FinTech in the UK was born out of the last financial crash in 2008, 2009. That's where you saw the catalyst for many of these platforms to start. And in the 10 years that kind of went by, we were building a way of underwriting and a way of dealing with customers, the smallest customers at pace. And I think that when the intervention came during COVID, again, the instinct from the government was to go and rely on the banks. And just like happened last time, the banks are taking a very long time to push that money into the smallest businesses in the economy. And that's something that they're not good at. So I think there was maybe a missed opportunity. I mean, it's kind of filtering through now that some fintechs are being accredited. But the very big barrier that fintechs have still compared to the banks is that fintechs are not able to borrow from the Bank of England, the central bank. So the Bank of England can give money to the banks at 0.1% here in the UK, whereas fintechs have to source their funding from banks or other lending providers at minimum 200 basis points, 2-3%. That basically puts a massive cost barrier in for some of the cheaper credit, some of the more prime credit. So I think as an industry in the UK, a lot of the fintechs now are coming together to say, in this crisis, we're a good mechanism to transfer money to the economy, especially the small businesses who need it the most. But we should also be able to access Bank of England funding to do that.
And we have the exact same issue in the US, where the banks have access to the Federal Reserve facilities, the fintechs do not, and there's been a lot of push on that. I mean, really, I'm a little biased, obviously, but I really think that fintech should have been involved in this from the get-go. They're used to dealing, and many of the small business lenders in the US are used to dealing with large numbers of small loans. Banks are not good at that. And that's what's been needed. You've seen all the furor in the US of publicly traded companies, the Los Angeles Lakers taking out money from this program, and many small businesses, millions of small businesses not being able to take advantage. So what I would have done if I was running the government would have said, let's get all the fintechs licensed before that we go out with this program. Let's let them have access to Federal Reserve money. And if the banks can play, that's fine. They can be on the same playing field. But let's have the fintechs service the most needy small businesses, because we've had, like any government program, there's been lots of waste, and the smallest of small businesses that are they're going out of business by the thousands, by the hundreds of thousands every day here, because they can't get access to this money, and it's because it's been so slow. So I feel like the government missed an opportunity, just like Anil said, that that they could have really done a great service to small business. We could have stopped the unemployment going up so dramatically here in the US, and they weren't able to do that.
Yeah. So yeah, I can only agree with these three speakers. So the only thing is that so it's about the guarantees, and I think it's about the funding. So what we've seen in Europe, so in the UK, indeed, like Anil already said, more than 1/3 or perhaps even 50% of all the small business loans are going through these online lenders. So it is not a small percentage, it's a lot. In the Netherlands, 25% of all the small business loans are going through online lenders. And still the government first looks to the banks, still looks for the banks to distribute these loans. And in fact, we are we need to focus more and we need to push more for an honest level playing field. There is no level playing field now. And so one of the activities that I'm personally now involved in is that together with another researcher, Karsten Wenslav, we're trying to get together all these insights in the different countries to share our knowledge on how to convince your national government, but also together how to convince the European Commission to make sure that the money from the ECB, so the funding or the guarantees from the EIF, they will be available, not only available for these alternative finance providers, but also that perhaps they are much more adapted to it. Because that's the problem also in most countries. These guarantee schemes, it's not that they are not open for alternative finance providers. Some of them are also indeed open, and you can get accredited also to CBILS in the UK. But it doesn't always really match with your business model and how you are providing your credit. So that's also very important, that for the next group of guarantee schemes that are being created now, because we are now not ready yet. So we now have the first group, and the first funding came from the government, and the first guarantees started to support these SMEs. But we need much more. And in every country, there will be much more money pumped into the economy. So let's make sure that the regulators, the policymakers, also get in contact with the associations, with the researchers that know how this SME financing industry works, and co-develop together these new schemes, make them much more accessible also for the alternative finance providers. So that's just one point I'd like to make here.
Cool, thank you. I'm going to ask one more question before I just go on to ask some questions that have been sent in to us. So last question from me, and if we can answer this briefly, and then we'll go on to, as I said, some questions that are sent in. One of the benefits of alternative finance for investors and borrowers is that because of technology, it often provides capital using different risk parameters than traditional finance. So what activities are firms undertaking to mitigate risk associated with their customers, i.e. like default arrears, etc.? I was thinking maybe, Anil, you might have a view, from your technology platform, ONS, any legal protections that you might be seeing?
So, I mean, is your question more, I guess, on risk underwriting at the moment? Yeah. Is that what really? Yeah. So, as I guess as I mentioned in my opening remarks, that's very much the focus, because a lot of the test of the fintech platforms, the platforms that will survive this, are the ones that have the ability to manage risk very carefully in the next 6 to 12 months. It's going to be tough. The market is switched in the sense that there's a lot of demand from businesses who want funding, but not all of them are good credits. In fact, some of them are very weak and might not even survive the next 3 months. So I think we made a lot of investment in being able to underwrite at pace and to get decisions back in 24 hours. We are doing we're doing additional checks. We have guided people now that it might not be 24 hours, it might be 48 hours. That just gives us another element of being able to check the machine and to get, revise our risk policies and to do additional fraud checks. Whenever there's a government-backed guarantee of 80%, 100%, then what we're seeing that there's a big increase in fraud attempts. So businesses apply because they think, the platform will just give us the money because 80% of the loss is guaranteed by the government, or 100% even. In terms of the latest scheme, the bounce back loans up to 50K is 100% government back. So you'll get a lot of fraudulent attempts of people who are saying they have a business but don't really have a business. So I think that the market now, it's about making the right decision versus making the fastest decision, if that makes sense. And I think that's something that is happening across the fintech peers. Obviously, we'll never be as slow as the banks. The banks will take much longer, but I think there's an emphasis on just getting that risk decision right and enhancing anti-fraud checks as well.
That's great, thank you. And Ines?
Well, to add to that, one thing that definitely can be observed is that there is a reduction in the loan volumes that lending companies are willing to issue and to process. And indeed, a number of them have made public statements that they have changed their credit scoring parameters and that they are now taking on only the so-called good borrowers, and they willingly want to avoid taking on additional risk for the investors included. So you can see that there is reduction to a certain extent in the loan volumes. In terms of what else one can see happening, given the change in the credit score of customers, is that a number of countries, as mentioned, they do have debt moratoriums in place. So this is already something happening to a loan after it has been issued. And you can see that the lending companies are processing various requests of borrowers to extend the loans, to change the payment schedules. And in some cases, it's not only not just requests, but this is something imposed by law, by national law, that they have to do and simply extend and give credit holidays, even if the borrowers don't ask. So that does have definitely, in a sense, a positive effect on the credit risk and the customers who would otherwise go in default during these times. They don't, and let's see how that evolves further.
Okay, thank you. Just reading one of the questions that's come in. Because of COVID-19, the fintech market and institutional investors may behave differently. What should be the strategy of the fintech investors and other actors to contribute in advancing financial transformation in such a challenging time? Quite a good last question to have.
Well, I'll take a stab to start off. I mean, I feel like it's interesting because I think most, like in the institutional investors here in the US, when it comes to lending, have really pulled back dramatically. In fact, some we have the Cultus, which is really the largest fund here in the US, have shut up shop. They just said, we're not, we're going to close. We can't measure risk anymore, so we're just going to close everything down, and we might launch a new fund at a later date. So that at a time when a lot of these lenders really need this capital, they've had it pulled away. And I think a lot of what's happening is you can only go to the people that you have existing relationships with, because no one's traveling anymore, and it's really hard to do due diligence. There's very, very few new sources of capital that are coming on board to a lot of the either equity capital or debt capital, and so I think it's a real challenge. And interestingly enough, in the US, the one kind of segment that has stayed with the lending platforms on the consumer side anyway are the banks. Because they're really going after more of a super prime customer, and they have the deposits they've got to deploy, and they continue to invest on some of these consumer lending platforms.
Yeah, I would just very quick response would be that many institutional investors are paused or cautious in these markets, which obviously is not great, when at the same time a lot of good businesses need access to working capital. So I just would echo what I've said before, which is that if the government is going to do one thing for the banks and give them access to liquidity, they should also do it for fintechs.
Great, thank you. Anyone else? Ines?
Yes, I can maybe very briefly add about retail investors, which seems to be a bit of a different story to some extent. We just conducted a survey with the investors. We had engagement of about 2,200 investors out there, so with a rather fair amount of investment volume across various credit lending platforms. Rather reliable source of information. And what is interesting to see is that at least on retail investor level, there is a fair amount of empathy with the borrowers. So the retail investors do understand the situation, and not only understand, but they do support the fact that borrowers who are now facing some difficulties, that they should get loan extensions, they should get their loans restructured and to help them. So I would say I could say that I'm even surprised that 65 strong percent of that investor count who participated in the survey said that they support the loans being restructured, and they would stay in with their investments. It wouldn't change dramatically their investment strategies or wouldn't change them at all. They're happy to stay being invested in this. And not only 65% would be happy with extensions and are okay to live with it, but on top of that, another 23, if I'm not wrong, were okay, even if they're not happy about it, they understand it. So the level of tolerance of the situation with the retail investors is I think a very positive one. And I think this is where we can see finally the benefit of the alternative market and the kind of the peer-to-peer market that we see out there. So if institutional investors, it seems, are more heavily affected by the events and financially affected by it, then the retail investors seem to be more tolerant to a crisis, and thus also the platforms working with the retail investors could actually be more tolerant and you know, to the events, and could go through this less affected.
It's fascinating. Thank you. Ronald, anything you want to add before we close to that?
I only totally supporting this, because I think this is really in the end of this crisis. I expect really that we see the power of the retail investor. So what we see now already on platforms and also outside platforms is that a lot of the companies that are getting into problems nowadays, retail investors, they stick to their companies and they keep on supporting them, giving them payment holidays, indeed, restructure their loans. And although indeed you need institutional funding for further growth, and you see that it's also needed in several industries, for a lot of the growth and the continuous growth that we see now for platforms that are still continue to grow, these are the platforms that have retail investors on board. And of course, they also have a problem now. They see that the companies they invested in are getting into problems, but they are much more in favor of trying to restructure them, if possible, than just getting out completely and don't invest anymore. So that's an interesting insight, I guess, from this crisis. And let's hope that it continues after the crisis, that the retail investors will invest even more and see that it's better to invest through these platforms than perhaps to invest just directly in stock market in large companies. They can use peer-to-peer lending, they can use crowdfunding much better to invest their money.
Thanks, Ronald. Well, I'd like to thank everyone for their time today. I think we could have carried on all day. I think it's been a really engaging conversation, but I appreciate our time is up. So I just want to thank everyone for your time, and I really appreciate it. I definitely learned a lot of things today. Tanya, I'm just going to hand back to you.
Thank you.
Thank you very much. This panel was definitely very interesting, as was the previous. I'd like to now invite Dr. Robert Wardrop to commence the close this session with his closing remarks. And Bob, you can, when you're ready, you can turn your camera on.
Thanks, Tanya. Aha, yes, of course. Thank you. Thanks, Tanya. I will be very brief. We've had a long session. It's been a very valuable one. Can we bring up the poll, Tanya? Because I think that the poll results are interesting. I think we'll kind of frame some of our thoughts here. So here's our poll results. We had very similar. This is exactly the same question I referenced when we opened, where I mentioned that we had asked about a large number of regulators, 50 plus countries, about 2 weeks ago, their views. We got 96% thought the rate of digital delivery of financial services in their country, the rate of adoption would increase as a result of COVID-19. Here we have 90%. I'm curious about the 5% decrease, I have to say. But in any case, it's quite a dominant theme. And I think it really plays into sort of some of the basic observations that were made. I think the discussion I found very interesting. Look, the presentation, I think, what we found in the results of the research was very much around variation, peeling the onion in effect to understand what some of the local and regional variation is in the development of some of the trends in alternative finance globally. That's the value of the research, is how to get a very macro picture, but at the same time, be able to go 1-2 levels down to understand what the regional variation is and what's driving that regional variation. And clearly, as we got into the discussion of COVID, variation was another theme. It's quite interesting. You know, Peter talked about just the actually the strength in POS lending, and whereas in business lending, it's essentially dried up in the United States. Ronald talked about the liquidity in Europe, and that sort of tied into something Ines said, because we've also noticed a growth of the voucher programs focusing on liquidity. And part of the motivation in the voucher programs in the US, they're often called gift certificate programs, partly because they're effectively unregulated in most markets, but also because in a way you're helping very local businesses as a lender. You're really taking the risk that you may never get the goods and services that you're effectively prepaying for, but the lenders slash gift certificate buyers, voucher buyers, are accepting that as part of a broader purpose, I think, with that notion of empathy that was raised, which I think we are beginning to see in certain markets. And I think clearly this is an existential issue for SMEs, or not for us, for businesses, particularly lending to SMEs, but fintech lenders generally. And I think Laura summarized it quite well. And this is really a test of resiliency. And it strikes me that some of the observation is that given the dynamics of what's going on in the market, the fintech lenders are in a very important and valuable position in terms of the financial system right now, closing the last mile in delivery, being very agile, but they're also incredibly vulnerable. And if they don't have cash, if they don't have partnerships, if they don't have good, robust credit underwriting, they're going to be very challenged to survive this period. And the impact of that on financial inclusion and the role that they can play, again, as Laura put, really from push to shove, this is something which the incumbent players and certainly policymakers have been trying to achieve for many, many years. FinTech, particularly in a digital environment, has a real potential to impact the levels of financial inclusion, but that vulnerability is a significant issue. And I left wondering, we're writing a paper right now, 3 of us in our research center are writing a paper with 3 authors at the Bank for International Settlements in Basel. And the topic of the paper is really looking at the development growth market share of fintech versus big tech, non-bank lending over the past 5 years. I won't describe what we're seeing in some of the data, but I do wonder if, in fact, the winner, if anyone's going to win in this, is really not perhaps the right way to put it, in terms of this accelerated trend to digital adoption that is so challenging for fintechs to take advantage of. Maybe it is the big techs that will be the ultimate winners here, as the drive for digital delivery of financial services accelerates. They may be in the position with the biggest balance sheets, with network effects, to be the ones that really capitalize. And I'll leave it at that. I want to just mention one other thing before I close, that there is, we in our center are, with the support of the World Bank Group, launching a COVID rapid response research program in the coming weeks, which will really take a look at some of these COVID response issues in some detail. That's going to be a relatively large-scale project in collaboration with the World Bank, and we look forward to reporting on that, hopefully, I believe, within 60 to 90 days. I think this is going to be very quick going into the field, and we'll be producing results on that very quickly, given the high level of interest in this area. So Tanya, with that, unless you have anything to add while my microphone is on, there you are. I think we're ready to say goodbye to everyone. Do you want to add anything to close?
Yes, I just want to say thank you to all of the participants that joined in today by video or by dialing in. I'd like to give a round of applause to the incredible panelists that joined us today and were super informative. And I'd like to just say thank you once again to Invesco, to the Inter-American Development Bank, and to the CME Group for making this project possible. And very, very heartfelt thank you to the 1,200 plus platforms that responded to this survey. Without you, this research is not possible. And all of us at the center have tremendous gratitude for your support, your participation, and the amazing work that you are doing, especially in light of the COVID-19 crisis. Thank you very much for joining us today. Bye.
Thank you. Bye, everybody.